Hello everyone and welcome to today's accounting tutorial video. In today's video we're going to walk through how to create the three financial statements in accounting. We will create an income statement that shows the revenues and expenses of the business. We will also create a balance sheet that shows the total assets, liabilities, and equities. And we will finish off with the cash flow statement that shows the cash inflows and outflows of the business. So in order for us to create the three financial statements, we will need to start off by creating our journal entries. Journal entries are essentially the building blocks to creating our financial statements. Essentially, they are a record of the various transactions that take place within a given time period, and they record each transactions in the form of debits and credits so that we can create a balance sheet. Now, the one thing I want to really emphasize as we're creating these journal entries, if we go back to our balance sheet, the most important equation in accounting is that assets must equal total liabilities and equities. And you can see that abbreviated here as in assets equals liabilities plus equities. So I want you to remember that as we walk through the journal entries here. So let's start off with reviewing some of these entries. So the first entry we had was an owner's equity contribution in the amounts of $50,000. So the owner contributed $50,000 to the business, and so there was an increase in cash, and so you will see this recorded as a debit because assets on the balance sheet are increased as debits and they are decreased as credits. And so in this transaction there was an increase to cash, therefore cash is debit $50,000. Now to create the credit entry, we will go ahead and credit owner's equity in the amount of $50,000. The next journal entry we have here is the owner purchased office equipment of $10,000. So again, we had an increase in office equipment, which is technically an asset. So here there is going to be a debit of $10,000. But because the owner paid this with cash, we're going to have to create a credit entry to display the decrease in cash. And so you'll see cash is credit of $10,000. Okay, the next transaction here we have, the owner purchased inventory on credit in the amount of $15,000. So in this case, we debit inventory in the amount of $15,000 to show the increase in inventory assets. But because we didn't use cash and the owner instead purchased the inventory with a credit, such as like a credit card, we need to book this as a liability. And so the account that we can use to book this liability is accounts payable. And here we will show credit of $15,000. Okay, the next item we have here is an increase in cash. So the revenue had $12,000 in cash sales. So we had an increase in cash. So you see the debit in $12,000. And we are going to credit revenue as revenue is typically credited to show the increase in revenue. Okay, on the next line item we have additional revenue in sales. However, these sales were not cash. So these were customers that paid for the products or services with credit cards. And so instead, because we didn't receive cash, instead we have what we call as an accounts receivable. And it's basically an account that shows that represents cash that is expected to be, that we're expected to receive, or in this case, the business is expected to receive. So here we had $5,000 of credit sales in the form of accounts receivables of $5,000, and we will also credit additional revenue of $5,000 here. The next item we have is the cost of inventory sold in the amount of $8,000. So here we will debit cost of goods sold, and this is an expense for what it costs us to sell the products or services. So in this case, it looks like the business sold some products, and the amount that it cost to sell those products was $8,000. And so the account that we will use to credit to balance the equation is inventory, because those goods are now sold, which are in the hands of the customer. We have a decrease in revenue in inventory in the amount of $8,000. The next journal entry we have is payment of salary. So the business has employees to pay. On January 25th, salaries were paid in the amount of $4,000. So there's a debit, and that was paid through cash. So we will credit cash here to show the decrease in cash. We also had utilities expense that same month on the 28th. We have a debit of $1,500 for utility expense, which also was paid in cash, showing a decrease in $1,500 in cash. Next journal entry we have is payment received from customers, age receivable. So on January 30th, some of the previous customers that purchased products on credit have now submitted payment in cash, and so here we will show a debit of $5,000 in cash to show the increase in cash, and we will credit accounts receivables as this account is decreasing as customers are now paying those balances that they had previously. The next entry we have here is a payment to supplier for inventory. So here we owed some money to supplier vendors, and so the business had to pay $15,000 for those balances, and so you will see a decrease in cash in the amount of $15,000. And lastly, we have some depreciation. So depreciation is essentially an expense to factor in the wear and tear of the equipment of any business. So in this case, we're factoring in a $500 expense of depreciation, and to offset this account, we will use what's called a contra account in the name of accumulated depreciation. And so typically with different kind of assets, so whether it's like a building or equipment or site improvements, there's typically a distinguished useful life for those assets. And so in this case, we're just going to give you a very simple example of some depreciation expense for the equipment that the business has. Okay, so that covers our journal entries. So now that we have our journal entries, we can move on to set up our T accounts. T accounts, so these accounts essentially serve as sort of a summary of the various transactions that took place. So you will see in cash, we recorded all of our journal entries that happened throughout the month. The left column here is going to represent all of the debits, and then the right-hand column here is going to represent all of the credits. And so you see cash ended with $36,500. Same with owner's equity. We had a $50,000 equity contribution from the owner. If you recall, the business purchased $10,000 of office equipment. Here we have a $15,000 increase in inventory that was purchased, but if you recall, we also sold some of that inventory off, which shows a decrease of $8,000 and then ending balance at $7,000. For accounts payable, it looks like we owed some vendors in the amount of $15,000, but later that month we went ahead and paid off those vendors, so we ended the month with $0 in accounts payable. In revenue, you recall there was $12,000 in cash sales plus $5,000 in credit sales for total ending balance of $17,000. From accounts receivable, if you recall, customers paid for revenue on credit of $5,000, but later that month they submitted cash payments. So here you will see a decrease to accounts receivable and an ending balance of $0. Cost of goods sold, if you recall, we had $8,000 of cost of goods sold, and you will also see the $8,000 previously to show the decrease in inventory. Throughout the month, the business had to pay salary expenses in the amount of $4,000, and then also $1,500 for utilities expense. We had a $500 depreciation expense for office equipment, and then we used the contra account, which is accumulated depreciation, to essentially track all of the previous track all the previous depreciation expense. And then lastly, we have an account called retained earnings. Here we're just showing $0. Okay, so that covers our T accounts. We can now go ahead and summarize all of these various T accounts to our trial balance. And here you see a nicely organized summary of the various balance sheet accounts that summarize all of the debits and credits. And so if you see this, these formulas are linked to the T accounts. So if I go ahead and click on inventory and just backtrack here for a second, this will take me to the T accounts of total ending balance of $7,000. If I want to look at revenue, we have $17,000. If I backtrack to see where that takes me to my T account of $17,000. So you start to see how some of these, how you start to see how everything is connected. And if you look at the T accounts, these are also connected to the journal entries, and so that's how we're able to sort of slowly, gradually build our financial statements, is by starting with our journal entries, moving over to our T accounts, and our trial balance. So now that we have our trial balance, we can now finish our financial statements. So we will start off by creating an income statement. So if you recall, we had $17,000, and you also see that the income statement is connected to the trial balance. So if you recall, we had $17,000 of revenue, we had $8,000 of cost of goods sold. So the difference between the two of this will create our gross profit for sales. And then the business also had some operating expenses. And you will see we had $4,000 of salary expense, we had utilities expense of $1,500, and we had depreciation expense of $500. So total expenses, we had $6,000 for the month, and so that leads us to our net income of $3,000. And net income is calculated by subtracting the $6,000 of expenses from our total gross profit of $9,000. Okay, so now we have our income statement. We can also record our balance sheets from our trial balance. So we ended the month with $36,000 and $500 of cash, and you will also see this links to the trial balance. We ended the month with $0 of accounts receivable because all of the customers that purchase revenue on sales, on credit, paid off at the end of the month. And then we ended up with the inventory balance of $7,000. So that gives us a total of current assets of $43,500. $43,500. As for our property, plant, and equipment, if you recall, the owner purchased $10,000 of office equipment. However, we did have $500 of depreciation expense, which gives us a net property, plant, and equipment balance of $9,500. And so now you start to see why we have this accumulated depreciation, because while we want to see the total cost of what we paid for the equipment, we also want to record the accumulated depreciation to draw down the value of the equipment over time. And so our total assets is $53,000. Next up, we have our liabilities and accounts payable. If you recall, we ended the month with $0 of accounts payable. And as for equity, if you recall, the owner contributed $50,000, and then we also have retained earnings. And so retained earnings, if you see, there's a formula here. We started the month, if we go back to our T accounts real quick, we started the month with $0 in retained earnings. And so for this month, we wanted to sum up our total income, net income, so $3,000. And so that leaves us with $3,000 of retained earnings, as this is net income is another word for earnings. And so typically, if a business were to distribute money, we would actually factor in distribution as part of this retained earnings calculation. So let's say the business distributed $2,000, our retained earnings would be $1,000. However, in this case, we will assume that there was no distribution made, and so we'll just leave our retained earnings at $3,000. And so now that gives us our total equities, liabilities, and equities of $53,000. And if you see, that matches with my total assets and total liabilities and equities. And so, if you recall, the most important equation is that assets must equal liabilities plus equity. And so this is a good example. If there was, let's say there was a distribution of $2,000, because I don't have a journal entry that records the distribution, the journal entry did not get factored into this balance sheet, and so the balance sheet's not going to balance. So what I have to do is go back to the journal entries, record a transaction or an entry for the distribution to be able to balance out the balance sheet. So let's just change this back to the original amount. Okay. All right. So now that we have our balance sheet, we can now build out our cash flow statement. And so here we're going to have three sections, which include cash flow from operating activities. We have cash flow from investing activities and cash flow from financing activities. So operating activities, essentially, we're just going to work backwards here. So we start off with net income. Here you'll see that it's connected to the income statement of $3,000. And then we're going to add back depreciation and amortization expense. And the reason for this is that depreciation is a non-cash expense. So there wasn't a cash outflow from the depreciation. It's just sort of a expense treatment to be able to factor to our equipment, the wear and tear on the office equipment. And so we're going to add this back, as this wasn't technically a decrease to cash. Next up, we have accounts receivable. So in this section here, we want to show if there was an increase or a decrease to accounts receivables. And so you'll notice there's some parentheses here, essentially saying that if there's an increase in accounts receivable, that's going to be a decrease in cash. But if it's a decrease in accounts receivables, that's going to be an increase to cash flow. And so for this month, there wasn't a net gain or decrease to accounts receivables, so there was $0 here. The next item here is increase or decrease in inventory. So if you recall, we started prior month with $0 in inventory, and the business owner spent $7,000 to acquire the inventory, and so you're going to see the cash outflow to represent the decrease in cash that took place to purchase the inventory. And then for accounts payable, there was a no increase or decrease in accounts payable, so therefore no cash inflow or outflow for the business. So total cash flow for operating activities is $3,500. For investing activities, we will record our purchase of office equipment in the amount of $10,000. If you recall, cash was used to purchase the office equipment, and so here we're going to show a cash outflow. And then actually we will also just kind of put that cash outflow there to represent negative. And then lastly, if you recall, the owner had made a $50,000 equity contribution to the business, and so that's going to show as a cash inflow, as essentially money is coming into the business in the form of equity contribution. And so the net cash flow is going to be the sum of the cash flow from operating activities, cash from investing activities, and cash flow from financing activities. And that concludes how we create the three financial statements in accounting. So I hope this was helpful. Feel free to take some time to practice the process to create the financial statements. And remember, the first step you want to start off with is to create the journal entries that properly record the debits and credits for the various balance sheet accounts. You will then use the journal entries to create your summarized T accounts here, which is, very nicely sum up the various transactions that take place. And then once you have your total ending balances, you can use your T accounts to create your trial balance. And so you can link your T accounts directly to the trial balance. And one thing you'll notice here with the trial balance is that this should always equal. And if it doesn't, that means that there's either a missing journal entry or some error in your T accounts. And then once you have your trial balance, you now have everything you need to create your three financial statements, which include the income statement, the balance sheet, and the cash flow statement. So I hope you enjoyed this video. If you have any questions, feel free to leave questions, comments down below. And if you have any further thoughts, I look forward to hearing your thoughts on this video. So thanks for watching and have a great day.